Yo, what's going on, guys? Welcome back to another video. Today I'm doing another trade recap, okay, on August 20th. And I was planning on taking this trade here live during this recording, but I already took it and I decided to manage it early and it was already too late. It's just in my TP. I'm gonna go over this trade real quick, but let's first go over the trades I took earlier today, right? Because I chose this specific day for a specific reason. And the reason is because there's a lot of things I want to go over today from today's video. Let me just check real quick my broker. Okay. Yep. Okay, my order got filled, so I hit TP there. Nice trade. Nice little trade. I'll probably go for the highs. But anyway, let's just go over real quick just trades I took earlier today, right? So my sessions. Okay. I'm going over gold today. And you can see based on the structure, we had a very small range in the beginning of the session here, which is why I tend to avoid trading pre-market, and we want to be trading during the most volatility time, which is the kill zones that I tell you guys the timings on. So just statistically, based on data, statistically, this is the best time trade for volume, as well as if you're trading Forex, you have no spread as well. Also, as well as if you're trading options, futures there's typically no spread, but if you're trading options at Forex, you will encounter spread. So trading during kill zones will also prevent those or limit those issues. But nonetheless, this was how I marked out my pre-market structure. Okay, early on we had a break of structure here. We tapped into a flip here, and we didn't quite mitigate the origin here, but tapped into a flip here. We made a new high, and the reason why I was fine with marking this as a break structure instead of inducement is because of this. When there's a lot of time that goes by and price is creating a new structure, new ranges, we tend to hold this as the new perceived value of price. So that's logically how price moves and works. And you can see we had a huge accumulation phase here. We were just accumulating, consolidating for a very long time. And so at this point, I realized we likely have found new value in the market, and therefore I can mark this as a break structure. Next up, we had two break structures after. These break structures, this one tapped into this flip here, which is nice. We did just barely miss the origin here, so I was fine marking this as a break structure for now. But likely you can see later on, this all became inducement for this unmitigated 1 minute OB right here, which you can barely see, but it's there, right? Unmitigated. We still have a gap to fill, an imbalance. So you could have traded going up here, targeting this weak high, right? All these highs are weak high. But because this was still potential inducement here, I marked this as a sweep here, right? Because you guys know what is inducement? Inducement is basically when price creates a fake change in character, which is what it's doing here, because the real strong low is not here. The real strong low would be down here time. So we never actually changed structure. This was a sweep, liquidity sweep, and we built structure. Okay. Now for me, the body closure versus candle closure is not as important as context. Because we have context built upon here that we still have a missing unmitigated origin here. So let me mark this as origin. This is likely to be inducement, and this high is likely to be weak. And if this high is weak, we're not taking shorts here. Do not take shorts here because you're actually still going counter trend, right? Since we're not marked this as a change of character, this is a sweep. Therefore, the other side, when you create a liquidity sweep, will be ran. So that's what happened here. And you definitely could have caught some very nice moves pre-market here, right? But I decided to, well, actually, this is not pre-market. This is 8:30 a.m. So this is pre-market for New York Stock Exchange, if you guys know, but not pre-market for gold because gold is already moving nicely after 8:30 a.m. EST. So great trade there that you could have taken off the origin with a limit order here because you have context built up. You have a lot of liquidity that just got swept, right? Money that just got swept, and now you're going with a flow of order flow. So you could have had a limit order and look at how price delivered. This is why in my journal, if you guys bought the journal, you will see that I have a column specifically talking about how price delivered. And if you focus here, you see how price had a big impulsive move down. And what I mean by impulse is we have a big range where it's all basically imbalances, right? Imbalances, 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 imbalances here, especially. We just have a huge gap to be filled here. Essentially, there's not much internal structure. That's basically what an impulse model really is in terms of delivery. So here, you definitely could have entered off the impulse, right? You would have got 4-hour trade here. With limit order, you probably would have got a bit more, 4.7. And remember, for limit orders, always try to keep your stop loss a little bit below the structure point. Okay, keep yourself safe. You don't want to get wiped out of these great trades here for a stupid low loss. So 5 are there off limit order. Now this is my first trade of the day. Limit order here. I noticed how price was delivering. You can see when price was creating this move, this was all imbalances. There's no micro internal structure here, right? If you really want to get into the details on the seconds, there was a small pullback here that created this sell to buy here, right? We have a sell to buy here that was created based on microstructure. That was how structure looked on the internal time frame, but that's very minimal structure, and therefore impulse model here off a limit order or limit order is completely fine. Remember, limit order and impulse model are used in the same context. Okay, so and this is the perfect context of when you should be using those models because they work very best when price just likes to push and take out liquidity like this. This is a very nice fast move, very nice fast move. This one struggled a little bit more, but still very nice impulsive move to the upside and not like a trade like this that I'll show later on. So later on, I'll mark this as a break structure, obviously, but remember, this is now our change of character because this low here is now strong because we took out liquidity and we created a new break structure. Therefore, what happens is this is how the market operates logically. When a market takes out liquidity, we tend to respect that point. If we're really taking out liquidity, if we have taken out liquidity once, this structure should be strong, and we should not expect another sweep of it. And if this structure still gets swept again, that means we're likely to actually head lower now because we just broke a strong low. And you guys know what happens when obviously you break a strong low, right? We change character and we go to the other side. So that's exactly what happened here. And a nice break structure to the upside. And also, another thing to note is we made all-time highs, right? Now, when you're doing all-time highs, obviously go with the trend, but we all know the trends at some point end, right? Especially if you're on the 1 minute time frame like this. This was all structure marked on the 1 minute, right? 1 minute swing structure, 1 minute external. And you guys know trends at some point end, right? So you don't want to continuously follow a trend, especially when it gets really high up in the leg or very high in price. Because in this point, I was expecting at some point we're going to have a reversal to the downside because if you look to the left here, let me just hide all these trades actually so you guys can see it's clear. If you look to the left, what do you see? We have a huge imbalance. Like, do not take trades off here. You would only be really looking for trades off this 4 hour or 1 hour OB here. You see, we have a huge imbalance that needs to get filled. And look how bullish we are on the 1 hour, right? So you guys know price likes to create retracements, and at some point, price will retrace. And that's what happened. Here, price came back to create a mitigation phase now, going down, because this was all this here was the expansion phase. Now we're going into the mitigation phase, which occurred very fast today. You can see because on the higher time frame, this is why cycling time frames is important. On the higher time frame, you see there was a ton of imbalance. Well, therefore, it makes sense why price created such a big impulsive imbalance move. Now here, well, what was I seeing here? From this point, I noticed, okay, we've been pretty high up in the leg. Okay, I noticed we had a bought sell here that is refined here, and there's no confirmation entry here unless you wanted to do a limit order impulse model, which you would have got stopped out on early, right? You would have taken an L there if you use that model here. That model here, is I would say it's pretty valid because of how price delivered and redelivered back. You guys see this is a bunch of imbalance here, right? So I'll say that is probably a valid loss there. But if obviously if you want more confirmation, you would wait for it and use the entry models with higher confirmation, higher win rates, which is what I told you guys in the first place, right? Limit orders and impulse model typically have roughly the same win rate I tested, and they typically also have the lowest win rates. So now we have the origin above. This would be the flip, okay? Fine. We have the origin above that's unmitigated, right? You see, this is why I don't mark fair value gaps as POIs. I teach you guys not to mark this because you can see you had some sort of reaction here off this fair value gap, and to us, the fair value gap does not matter. We're waiting for it to completely get filled. He taps into origin, and what was my thinking here? My mindset going to this trade was targeting this low here. And if you want to know the reason, it's because this strong low got taken out previously by this move here. So despite making a new high, we then created a new low. This is a change in character here. Okay, and in the left, you can see how mitigation works. We actually mitigated something unmitigated on the 2-minute chart. Okay, and you can later see that we have shifted order flow to potentially go bearish. Now, could this be a fake change in character here? Potentially, right? We could have potentially a double sweep, an internal liquidity sweep, and then an external liquidity sweep. But to me, we were already very high up in the leg. Well, there's not even a leg here at this point. We're just trading. We're trading when there is no really valid PYs to the left because this is all-time highs historically, right? Gold is going insane right now. And so in this situation like this, I'd rather trust my structure, and it's telling me right now we're likely to go bearish. And what's another key sign that we're likely to go bearish? Well, I was looking at how price delivered in this leg here. This is something a little bit more complicated, okay, a little bit more experience based, but this right here is the last thing that's unmitigated. And typically, if we truly want to go higher or lower, if we want to go higher in this case, we would have something unmitigated here, visible on the 1 minute, and there was nothing. This was the 1 minute unmitigated, and it's high up, right? I want to say it's high up in the leg, but it is not at the extreme point of structure. And what this is telling me is that we're likely to take out this low. It's basically added confluence. So now what you don't see is if you go to the 30 seconds here, this wasn't even on 30 seconds, this was on 15 seconds. There is a 15-second unmitigated PY right here. You can see that perfectly. And now you know why the market is doing every move. Every single move in the market is calculated. It happens very precisely. Like people don't understand this after years of trading, but I'm telling you guys here now, everything is accurate and precise in the market. Okay, it's not a coincidence price came back to mitigate this second's POI. Look what happened. You had a bullish move here. You could have caught a trade off the seconds if you trade seconds here. Let's see. Well, we had an OB here, OB entry model here. On the seconds, target that origin here or flip right here, and boom, 5R, just like that, off the 15 seconds. Now, for me personally, I stay lowest typically to 1 minute, but what I do, okay, for seconds is when I see a big candle, and just something important to note, when you see a big 1 minute candle, something like this, I like to go on the seconds. Why? Because when you see a big impulsive 1 minute candle, what it's telling you is the move was really big, and when we have big moves, we have displacement, right? And when we have displacement, meaning big moves that go very far away from obviously liquidity, we typically have imbalances and fair value gaps. And when we have those, typically you will see them on the seconds and not on the 1 minute. The 1 minute will likely not show that imbalance because of just how fast price reacted off of it. So that's the main time when I go to the seconds. Otherwise, typically I don't go to the seconds for any types of POIs. This is more of a rare situation when you don't have anything visible, maybe at the structure low, right? Or extreme structure, which here at the origin, we don't really have anything here. So I had to go to the seconds, and that makes sense why price reacted here. Now, this is why I don't trail my stop loss. If you're trailing, let's say you trailed here because you were thinking this OB might hold here. Well, what happens is you get stopped out of your winning trade just for it to later hit your big R, which went for basically AR here. And you can see price created an internal sweep again. So if you were like throwing a stop loss here and then you throw a stop loss here, you got swept again. This is why I don't throw my stop loss and I stick to my plan and analysis and thesis. And now, of course, you need strong conviction to obviously hold through price reacting like this because uh, this is a reversal, right? In terms of price action. So this is something you want to be careful with. This is all depends on what your personal trading system is. I told you guys for me, I manage at break even, stop loss or TP. I don't trail my stop loss and profit really ever. Only maybe sometimes during news, but usually I don't have a trade open during news, so that's not really a problem for me. But you guys will now understand that there's you go. That's why price reacted off here so strongly. If there was nothing in the seconds on here, price would have easily taken out this low. Easily. And you can see what happened later is price had a big dump. So I missed out on this trade a lot. I missed out on 22 risk to reward. And if I'm gonna be honest, at this point in my journey, I don't mind. I don't really care too much that I missed out on this much. Why? Because moves like this don't occur often. Okay. This is a rarity. And actually, this is something I should have capitalized, but I just didn't because I forgot in the back of my mind. I didn't have this in mind when I was looking on the chart that we had such an impulsive and big imbalance to get filled on the 1 hour. And so because I didn't recognize that ahead of time, I missed out on this big drop, right? Only got a piece of it, which to me, completely fine because AR is still great. Like, don't get me wrong at all. It's still great. But our main job as traders, in my opinion, is we want to try to catch, like a goal of mine is to try to maximize as much as possible, catching at least 75% of the trade for the winning move. And the reason for that is because we want to maximize our winners at our losers and obviously have a good win rate. And for me, my win rate has not been really a problem for me at this point in my journey. The for me, I would say, based on looking at my past 3 months ish, I believe, of data, that's if I can pull it up right now, actually, let me check it real quick. Let's see. I have a data tracker where I track manually what percent of the move I catch really and whether or not I caught the majority of the move. So what it defined as majority of the move is greater than or equal to 75%. So if you take your tool here, you can see situations like this, I would say I caught the majority of the move because it was just a two candle difference between the very tip and exit and where I TP'd. So I TP'd around 75%, which is great. This is a great TP. It's a great trade. But a trade like this, for example, maybe I would actually wrote this in my journal that I did not catch or capitalize on this at all. I only caught about 25% of this move, and that was AR. So yeah, but again, moves like this don't occur often. So please have realistic expectations when you're trading. Otherwise, you will get your win rate very low and you'll get cooked by the market because you have unrealistic expectations. For this trade here, I mean, you can already see the setup. It's just an OB entry model confirmation off the origin here, right? You got an OB here. You can see there's a gap. It's a little hard to see, but hold control on your keyboard and you can magnetize to the wicks. You got an OB there. I set my stop loss right above the high here. What I do for my stop loss, by the way, is if it's very close to the high, I'll just put at the high or low. If this OB is like very far down, I'll try to typically put my stop loss like covering just the OB a little bit. Otherwise, if it's very close to the extreme, I'm not gonna care too much, and I don't mind having a safer trade because realistically, the trade is not invalidated until this high breaks, right? The extreme price breaks. So that's what happened there. OB entry model here. I broke even here of this trade here, okay, and I almost got hit out here. Very, very close. It's extremely close here. Almost got hit out break even, but I'm very glad I didn't because man, that would have been very unfortunate for me. And this is when psychological issues might occur, right? You might start chasing price now, entering here or here and having bad risk reward trades or having very tight stop losses, but then you get stopped out, obviously before your real target of this level gets hit. So these are very things you want to consider when you want to consider how you want to manage your trades. Do you want to manage your trades based on like a stricter system with break even, or do you want to have it more like a set and forget system where you don't have re-entries and you just set and forget stop loss TP and that's the outcome of your trade, right? These are all things you want to test out with your psychology because I can tell you the data from a data perspective, implementing break-even system will improve your win rate by about 10%. But, but, if you're very bad at managing your break evens, like if you're choosing very bad places to break even, then it could get a little iffy, right? And the best, like most, if you really want the best optimal way in terms of pure edge on break, is you want to basically break even, um, depending on context, depending on the market, right? Market conditions, how price has been trading, and how good of a setup it is. Let's say it's a pro trend setup. Let's say it's a pro external trend setup. Maybe something like this. Let's say you had an A plus setup like this. This is pure A plus setup here for me. This is just a continuation model using a limit order. Let's say you had a setup like this. I would you would then optimize to not go break even at any certain point in the trade. You just hold to, instead of set and forget because you know potentially price might come back to mitigate, which it did here, this OB before it continue higher. So that all depends on your trading plan. But for me, the most optimal way would be break even for certain trades and break even for other not certain trades. And I'll show you guys quickly in a second here why. Or a perfect example. This trade here, okay, I was on the higher time frame. I found a flip here, flip zone. This obviously was not the extreme of the leg. The origin is already down here. And we had another flip down here, okay? So this is not the A plus setup, right? This is not high quality. Why is this not high quality also? Because we just dump like crazy, right? And typically, yes, when we dump, we will get some sort of slow retracement, like I tell you guys. However, it's going to be a lower win rate to try to catch the very bottom of that retracement. You want to wait for a structure to build new ranges before trading, right? Like something like this. You want new structure to get built and not trade immediately after structure like this, where this is an impulsive move and no clear structure to trade off. So this is when you really want to implement a good break-even system, right? So this is when I get picky about my trades. I will manage my trades a lot more stricter where I know I'm clearly counter trend, in this case counter internal. External on the higher time frame you could say is still bullish, right? We're still bullish. This is just a mitigation to potentially make another new high. But for now, we're not close there yet. Why? Because if we were going to create a new high, we're likely to come back and revisit down here for better pricing. So this flip here it potentially cause a tiny retracement trade, but it's not going to be the main move. So you're actually still not trading the external properly. You got to know you got to time these trades well. So that's why when you take a riskier trade like this, for example, I am clearly going to be managing my trades a lot more stricter. So for example, I would break even immediately after structure breaks here. I chose this point here, I broke even here, right? And now here's another topic I want to talk about for today. And it is re-entries after break even. This is completely up to you, up to your risk management in terms of how many losses can you have per day for you, or maybe if you don't have a rule for that, then maybe I don't know, you want to test this out for yourself, right? Everyone's psychology is the main thing that's different. You can view the market roughly maybe 80% the same. Once you guys master the system, you could probably view the market about 80% or 90% the same as me, but your psychology is going to be very different regardless, right? Because it takes time to practice and build habits and discipline. Here I took an inverse for value gap model here. And I entered a little bit late here. I should have entered off this body closure above, but I entered there. Late entry, and I got stopped out. Re-entry. I labeled it in my journal as well. Make sure to label your re-entries in your journaling, or data collection at least. So then you can look back and see if re-entries are worth it for you in terms of your win rate. Do you perform better? Is your expectancy better with having these re-entries, or is it worse? If it's worse, then obviously stop taking re-entries after break even, because typically the point of break even is you likely know you're wrong, so you're trying to protect your capital, right? So re-entries are kind of counterproductive and don't make as much sense after break even trade. But and when I say re-entry, I'm talking about like before price hits your original stop loss, right? Obviously, if price um, like takes you out break even and then creates new structure and confirmation, you could obviously take another re-entry there. I wouldn't call that a re-entry. I'll just call that a second attempt. A whole different trade idea. But this is like the same trade idea. You just think you got stopped out at break even early, and you think and still believe price is going to be bullish from here. That's why you re-enter. And obviously, it didn't work out in this situation. There's no way to manage my P&L here whatsoever. Stop loss here is valid. There's nothing for me to break even at really. This is way too close to break even at this wick. So took a full on loss there. Completely okay. Um, and like looking back, like in reality, I shouldn't be trading this aggressively here because it's not a good QI to pick. It's not close to the extreme, so not the best trade idea to re-enter there. So I definitely journaled that for sure. And then now this trade here, off the flip, and this was another break even. I entered this off the OB. I have my stop loss above here. What you can do is if you really believe price is not going to come back for this OB here, this extreme OB here, you can have your stop loss there to cover this entire OB here, or cover to sell to buy to sell. But just know you're sacrificing your risk reward for you're sacrificing your win rate for a way higher risk reward. So depends how you want to manage that. Me personally, I'd rather have a lower risk reward than get stopped out early of a trade where then I might not be able to have a re-entry, right? Which would suck. So that's basically that trade here. I broke even here. Very nice internal break structure, broke even, right? Knowing that this is a flip, less likely, and also on the higher time frame, we tapped into this. Okay. We are heading very close to the higher time frame. I believe this was 1 hour. Yep. 1 hour here. We had a 1 hour sell to buy here. Okay. And we tapped it. And if you want to refine that, you would have refined it to this 1 minute or 15 minute or 5 minute, whatever you see. Remember, flip your time frames. That's very important. And here this is just a counter trend trade at this point because this is pro internal. Internal structure is bullish, right? We took out this high previously, so this was my strong high. I expect price to do something like this, take out this low. But in this case, I wasn't looking to the left enough here to notice that I'm in very high time frame demand, and I should stop looking for shorts here. I just start looking for longs. This is called anticipation of price, and that was my mistake. I should have TP'd. Probably shouldn't have even taken this trade, but now I know that next time I need to focus more on going to the higher time frame, right, before I go back to the lower time frame, which is very important for context. This was a 30 seconds PY here, right? I tell you guys, when you have a really big candle at the extreme structure price leg, whether bullish or bearish, you want to typically go down to seconds because there might be something on the seconds that you just can't see on the 1 minute because how fast price moved on 1 minute. Now, this is not necessary, right? If you had your anticipation of price correct, right? And if you had this 1 hour demand marked out, you would actually be looking for longs here. And so you would have probably waited for price to have a POI. In this case, you probably wouldn't have seen the seconds one, but if you did see that one, what you have, an OB model here. And then what would you do? Your target will obviously be this high here because you're anticipating this high to be weak because this is a potential failed break structure here, right? We failed to take out this low, and therefore this is a weak point potentially, and you would target there, or you would even go higher and maybe target this origin here, which is probably what I would have done because it's very close to that external swing structure. So you would have got a 6-hour trade there. I just messed up here, right? And this, to me, is not greed. I don't like to look at things in terms of fear and greed. I like to look at things from a technical perspective. And from a technical perspective, the mistake I made today is really just not focusing enough on a higher time frame. Now here, at this point, I should have shifted my bias, but clearly I did not, right? Because my strong high was still held here. So I was hoping to see maybe we had an QM model here to go lower, and obviously that didn't happen. So again, very strict break-even management on low quality setups. And so this is what I want to really talk about today, really was just discussing break-evens, right? Just knowing when is best to, or the best time to implement a break-even system is on a lower quality setup. And the times where you don't want to break even or want to avoid using any type of break even system is if it's an A plus setup like this right here. Then you want to typically avoid using break evens. I also want to go over this. I think I mentioned this. I forgot if I did, but remember failed break structures? I was talking about this in the market structure videos, right? In the course. Okay. We're supposed to break this high if we're truly bullish. Why? Because we ran liquidity and we should be still bullish. But obviously, this change of character here, let's say you mark this wrong as a sweep. Well, in this case, you would be expecting a new break structure, right? But here we failed to take out the high. And at what point, I might get asked, at what point do I mark this as a failed break structure? Well, I went over this in the course videos, but I'll go over it again. The point of when I mark it as a break structure, or failed break structure, is when price taps the origin and or flip, right? But in this case, origin was the best. And price gives me a basic confirmation model. So either OB entry, fair value gap entry, or inverse fair value gap entry. Those are the three main confirmation models I will use to confirm that price is likely to reverse. I do not count impulse model as enough confirmation for structure, right? So use the high win rate entry models, and you will have a higher win rate. And so I would mark this as a potential failed break structure here as soon as I see some confirmation of a reversal, which is what happened here. And you truly can't confirm this failed break structure until price actually puts in that low or high. And when price puts in that break structure, this completely confirms that this was a failed break structure because price failed to take out the high and run the high. Instead, it took out the low. So therefore, we're reversing now. So at that point, I was like, okay, this is a failed break structure. I can actually hold this trade till the very end because I realized here that especially there might be something in the seconds and just hold through this because I've seen this happen. I've seen this happen before. This is when experience comes into play where you don't let your emotions get the best of you and don't get scared. I've seen things like this happen. An internal sweep off a mitigation of a PY again while you're still in the trade where the draw is higher or lower. So that is that trade. If I want to go over more trades here, this trade was very late. Okay, this was off a flip after I shifted my structure, after shifting my bias basically here, right? My bias obviously after taking out the strong high. Now this is a break structure, and in this case, let's see, this would be a change of character because that was a strong high private, right? We took it out. Nice closures above. Again, this is body closure and wick closure is not extremely important, but definitely something you can add into your bag if you want to focus on confluences, right? Remember, going on a higher time frame and see if it closed or not. That adds more confluence to your trade playing out. Here, we have a flip, and let me turn off this. We have an origin here. The origin never got tapped. It tapped into the flip. What do I do? Well, I wait for my entry model here, inverse fair value gap model here, played out. I really like to use inverse fair value gap models when I can get a good risk reward off of it. Meaning when there's like a survive gap, inverse survive gap that's very close by, near like the lowest low or highest high being created, I like to take those because it gives me a good size small stop loss. Now this inverse survive gap, if I wait up here, this is a 1 to 2, which I don't like taking. I like to typically aim for at least 3 to 4 RR. So that's just what I found from testing that works best, by the way, for optimization. So I would have preferred taking this inverse survive gap and manage my trade more aggressively. So like maybe when price taps into this supply here, maybe I might manage my trade to break even there instead. Instead of entering there, I managed to break even there. But again, this is a very high quality setup here because we clearly failed to hold supply here, and clearly buyers are in control now. And so we would take this, right? Here's value gap and target the weak high because the highs are now weak. Remember, we don't always go back to the origin necessarily price. There are times where we just come back to the flip. And later, this could be potentially treated as inducement for later. But you can see price decide to create new value in a new range, and this is when we then mark out our new range, right? Price will not always perfectly trade like this. Price will not always perfectly trade like that. So you want to keep that in mind when you're trading. Okay, so after that trade, this was an Asia session here. Well, I took this actually before Asia session here. Because I was gonna record this actually. I was gonna plan on recording this a bit earlier today, but I guess not. So this trade here, took it off an OB entry, bottle, limit order at the OB, stop loss below. You can put it here too, but remember what I say. If it's very close, I'd rather be safe than sorry. Keep it there. And then what I target here, 5 minute. Boom. That was my target. 5 minute right there. You can see price just barely hit it and then reversed. So that was my trade here. I gotta label this for my journal, but 3R hit on my broker. Very, very nice trade here. What was the logic behind this trade? Well, I noticed we created a new range, right? This is all internal, right, to this external leg here. So we are still maintaining external bullish structure. It's just that we're creating an internal structure that is tradable. This internal structure is tradable because we have a big range. These ranges are very nice. We can get good risk reward trades out of this. Give you some examples here. You could have had a retracement trade here. Okay. And then you TP wherever you feel free to. Remember, you have your um, more safe TPs, and then you have also your more not as high quality TPs or not as likely TPs, but give you more rewards, right? So it all depends also on your risk tolerance on how like you like to trade. Do you like to be more focused on getting it perfect, or do you like just be fine with catching a good piece of the move? For me, again, 75% is my favorite rule when it comes to winning trades. I like to maximize my trade potential for my winners as much as possible, which is closing out full position, hopefully at least 75%. In this case, I would count this as base 75% because there's just one big candle after hitting external that really caused the difference, but that was it. This trade here obviously is catching majority of the moves, at least 75%. Things I would journal, right? You could refine this on a 1 minute, right? If I refined to the 1 minute, I would have caught more, but there are times where the 5 minute gets respected, so I'd be careful there. And then you can see price is clearly now going lower. And we're going back to what? This 5 minute origin. And in fact, this 5 minute origin is potential inducement. Do you see this inducement? So we potentially could run this inducement, tap into this origin. Let me draw it better. We could potentially run this inducement, tap into this origin, and then make a new high, right? It's just all about thinking about possibilities and probabilities of each possibility happening, and you trade off those. You can see right now we're reacting off this origin here, and we'll see if whether or not it is high time frame inducement or not. Now, this gets a little tricky here also because of all the structure, like creating new value in the market. So maybe structure on the left is irrelevant now, and therefore we're now following this new structure here. So we'll see what happens here. But I'm pretty satisfied. 3R during 80 session is nice. This honestly was taking a little bit more before 9 o'clock, which is a new session timing, and it's mainly just due to what's it called, daily savings. So that's it for basically today's trade recap. I know this was a very long one, but I really just wanted to pinpoint like the importance of how you manage your trades and in what kind of situations you want to optimize your trading, as well as the 75% rule. So if I want to recap today, I went over best optimal way to manage trades to break even. A plus setups, no break even management needed. Anything lower than A plus setups, be strict on your break even management. This will save you from a lot of losses, by the way, if you're strict on it on low quality setups. And you want to be more flexible and loose on the high quality setups. Journal collecting data, goal of catching 75% of the move on winning trades. You want to maximize risk reward, maximize your winners. Okay, this is basically the sum of today's session. It's getting long here, so I'm going to end it here. I really do hope you guys take something out of this session. And yeah, I'll see you guys in the next one.